Alex, first to you. What's going on here?
Well, I think there was maybe a hope among legacy media executives that it was tied to Netflix in both a bad and a good way. In other words, the air came out of Netflix last year when the narrative around streaming growth died. We saw Netflix shares drop 60+%. And along with that drop, all the legacy media companies that had spent the last 3 years turning themselves into something that looked more like Netflix, in other words, launching their own streaming services and pivoting their businesses around streaming, their stocks came down too. But what we've seen this year is that when the air has been pumped back into Netflix and there's suddenly excitement around Netflix and potential growth there, we have not seen the same bounce back effect among the legacy media names. In other words, there is excitement once again in the Netflix growth story, and there is not excitement in the Disney growth story or the Warner Brothers Discovery growth story or the Paramount Global growth story. And so that's where we are today.
Right. And the numbers, it seems, Gene, first out of the gate, there's so much excitement. Look at this shiny new product. Look at the subs they're adding. And then a couple years go by and you're like, it's not enough. It's not profitable enough. It's going to require more investment. You say that there is something bigger going on here with the content. Give me the numbers and tell me what you think that is.
So, Kelly, there's three major pillars when it comes to content. There's legacy, there's streaming, and then there is creator content. And the focus for the first part of the conversation is around the legacy and the streaming and that dynamic. But ultimately, I think there is a bigger piece that's going on. This is related to the creator economy. And if you look at the growth of Netflix, let's say this year, the Street's looking for 7% growth. Next year, 12%. In 2025, 11% growth. I'll take the under. I expect them to miss their 2025 numbers. But you compare that to what's going on in the creator economy. This is Goldman has a report out that expects that this through 2027 will double to $500 billion in total ad revenue related to creator economy. Netflix will do $43 billion next year. So I think that there is a gorilla in the room here, and that is ultimately the creator content, that creator economy. So I think that is something that as investors figure out this dynamic between legacy and streamers, they need to keep a close eye on what's going on with the creator economy, because this is going to capture a lot of millennials' viewing habits over the next decade.
Yeah, fair enough. And Laura, where would you say that leaves? We've talked a lot about some of the challenges you think Netflix faces. They are, by the way, doing a live sports, thing this fall. So maybe there's more to come in that vein. Should they be pressing their advantage right now? Who wasn't a Discovery the other day who made some content sharing deal with them? I mean, should they be really leaning in and saying, hey, to the other media companies, we'll pay you. You get the cash flows right away. It's less of an investment for you over time. We win, you win. I think Alex had a piece about that the other day, Laura. But is that possible here, that Netflix could really press their advantage?
I think they could, but I want to build on Gene's comment, because I really agree that we've moved to an attention economy. And so user-generated content, which is low cost, is really taking a lot of attention from younger demos. Similarly with video games, we have a lot of young men under 25 who don't watch any TV, including sports. And so they're taking attention and moving it to the video game space. And so I do think that all of the economics of these streaming companies are compromised by these new areas of attention grabbing. And TikTok comes right to mind, so does YouTube. The point is that what Netflix has done so well is they added advertising, which none of the legacy guys could do because they already had advertising. And now with this passport sharing lockdown, both of those, and they've said they're going to be cash flow positive. So they are one of the few that are going to be growing their returns on invested capital as a proxy for free cash flow over the next 3 years. All the legacy media are trying to, battle cord cutting, which is going to hurt their returns on capital.
Is it just a better mousetrap, Alex, user-generated content and the big tech platforms that would benefit from that versus legacy media?
I mean, it is today. Certainly over the years, the legacy media companies have poo-pooed user-generated content as low-quality content. And the general thinking always was, yeah, younger people watch this, but younger people get older. And when younger people get older, they're going to want quality content and they're going to pay for it. I don't know if that's the case. And one thing we have not seen, which I think is an open question, is the legacy media companies getting into the game of either user-generated content or video games, to Laura's point. So will that be the next iteration here where we're able to see acquisitions or organic growth in these different directions, new avenues of a potential new narrative for these companies to get investors excited? Maybe, but some of these video game companies now are quite large, so they're going to be significant acquisitions that are going to need to be passed by regulators, and you're already seeing Lena Khan and current regulator staff block the Microsoft deal for Activision. So if a media company went in that direction, we'd have to see if that deal was allowed by regulators.